Hi, it's Professor J. We're ready to start part 2 of transaction analysis. Now, first of all, let's say that this business that we have we sell lemonade, and we do two things. We sell the actual lemonade product in little glass jars, and we do lemonade tastings. So in other words, we not only have sales, but we also provide services where we go out and do lemonade tastings and talk all about where the lemons come from and things like that. So we can have sales revenue as well as service revenue. So first of all, let's do a bunch of transactions that focus around asset accounts. Then we'll move on to liability account, and then the most fun, stockholders' equity accounts. So first of all, let's buy a car. Because we do tastings, we need to have a company car. So we still have $80,000 of cash, but we don't want to use it all up, or a bunch of it up, on buying some cheap little car. So what we're going to do is we're going to go to the car place, and we're going to put $10,000 down in cash, and we're going to sign a note payable for the balance. So we now have a note payable for, I think I said it was a $20,000 car. Let me put that on there. We now have a car worth $20,000, and because we went up in car value from 0 to 20K, we go up and out to the debit side, and we will debit car for 20K. We now know we need credits of 20K somewhere. We put $10,000 down in cash, so we're out cash. We're going to credit cash $10,000. Our asset side now has a net increase of 10K. We put a debit of 20K, and we credited 10K of cash. The only way to balance that is we need another 10K of credit somewhere. Well, lucky for us, we said we're going to take a note payable. So note payable, we have 0 in note payable. Our note payable is going to increase, isn't it? Well, to increase a liability, look at the right side of the heart, right down there. We go up, we go out. So we are going to credit note payable for 10K. And there we have bought a car for $10,000 down and a note payable of 10K. So life is good. And we move on to the next thing. We are going to buy office supplies now. But we're not going to use our cash. Once again, we are going to run the company credit card. Now, anytime you hear the word credit card, the word that should pop in your head is account. Account receivable or account payable. Account payable is when we run our company credit card or run a card. We owe somebody, don't we? Basically, we gave them a big fat IOU. We haven't paid them cash. We gave them an IOU when we run our credit card. If someone runs their credit card in our store, they owe us, and then it's an account receivable. So right now, we are going to run our credit card. So we are going to have an account payable for the amount of office supplies that we buy. So let me put office supplies here. And by the way, you just name accounts whatever fits. Now, you're not going to come up with some fancy name for cash. Cash is cash. Accounts receivable are accounts receivable. Inventory is inventory. But other things you can name at will. So generally you want to use the names that are in your homework assignments. That helps make it easier. But account names are just made up to fit what needs to happen. We need office supplies. We're going to make an account called office supplies. And we're going to pay for it with our credit card. So office supplies as an asset is something the company has. So we must debit it because it increased. Let's say we bought $10,000 of office supplies. So we'll put 10K there. and we're going to pay for it with an account payable, which is a liability of $10K. We had none. It increased to $10K, and on this side we credit to increase. We're still doing good. Next transaction, little stickier. And actually, I need to draw another T account. It's not in blue. Sorry about that. But we are going to prepay our rent. I never did. We should have probably done that right up front. Otherwise, we have all this inventory and office supplies in a car and no place to stay. But we're renting a place and we want to prepay our rent. We're going to pay for a whole year in advance. And we pay, it's a cheap place. We're practically working out of a shed for this lemonade business. So we pay $200 a month. So to pay for a year in advance, we are going to pay $2,400. Now here's the thing. Prepaids, whether it be prepaid insurance, prepaid rent, whatever, it is an asset. It is basically a rent gift card. It is something the company has that we haven't used up yet. So what did we do? We bought a rent gift card for $2,400 to help us pay off 12 months worth of rent at $200 a month. Well, what did we pay for that gift card with? We paid cash. So that has to come out. That would be, here I'm using K, so to be standard, I'll say 2.4K, because K equals 1,000. So I probably should have put 2.4K on prepaid rent as well. Let me go ahead and do that. Scribble that out. Put 2.4K. So everything's in K. A little more standard. All right, so that is just some asset transactions. Let's go on to a unique liability transaction. Earlier on in video 1, I told you that pretty much all your liabilities are going to end with the word payable. Well, and that there was one weird one called unearned revenue. We're going to make that account right now. Unearned revenue in liabilities. What that means is, remember I said not only do we sell little jars of lemonade, but we also do lemonade tastings where a person goes out to someone's place of business or birthday party or whatever and lets them do tastings of different kinds of lemonade, talks about it, that sort of thing. It's a service provided. Well, someone came in and paid for a lemonade tasting and the lemonade that they were going to purchase for their birthday party in advance. Key word, they paid in advance. Let's say this cost them $1,000. Well, until we actually do the tasting, we have not earned that money. It cannot be counted as revenue that our company has earned until we actually earn it. Go figure. So, unearned revenue, they came in and paid us. What would it affect? It would affect a liability, unearned revenue. We owe that money back to them if our company folds tomorrow. We owe them $1,000. Or if they change their mind before we actually provide the service, we have to give it back. So until we provide the service, it's unearned and we don't get to claim it. It's a liability. We owe it back to them. So what happened? They walked in, they gave us cash. So our cash went up by $1,000, and that would be a debit. It went up. So I'm going to put 1K under cash, and unearned revenue, a liability increased on this side, is a credit. So there you go. Now you've had a bunch of asset transactions, a bunch of liability transactions, and now we're going to get to the last and probably the most confusing area, which is stockholders' equity.